Good day, fellow investors. We continue with our series of soft investment topics, but extremely important, so click that like button if you enjoy these videos. And today's topic is about portfolio exposure. So Andrew asks, how much of your portfolio would you or anyone else allocate to emerging markets? I'm currently sitting on 18.4. And my answer is, I don't allocate by markets, I allocate by value. If we go to my intrinsic value comparative table, if you look at my valuations of emerging market stocks compared to what we have in developed markets, it is about value, not about countries. If we look at Facebook, from my perspective here, Facebook still offers a pretty good return for a 10% expected return. So it is undervalued from that perspective. This is a downloadable table. If you want even better value, you can check my stock market research platform for the premium version of this table. But if you look at many other companies like Boeing, Caterpillar, Cisco, the returns expected there are around 4 or 5%. So emerging markets, if we look at Baidu, for example, Facebook, with the global exposure there, then emerging markets offer better returns. Alibaba compared to Berkshire is still offering a good return, but Alibaba looks like a better return. And then going back to the question, how much of your portfolio, I think that my portfolio is, apart from the 20% hedge, it's 80% not really emerging markets, but mostly emerging markets, but commodities, emerging markets, of course, you know about Alibaba, and there is the value that I like the businesses over the long term, and then it's also always about comparing that value, adding on to that value, enjoying the portfolio position, looking at why you own it, reinvesting the dividends into something else if you like it better, and building a portfolio. I always see people focused on allocation, and then something goes up and they sell it because the allocation has went up. That's not smart. If the quality of that went up and the price went up, just let it there, no matter the allocation. And focus on value, not the portfolio allocation. It's always academically nice, oh, be diversified, 20% here, 20% there. Ray Dalio all-weather portfolio, but if you look at Ray Dalio's performance, he has just smoothened the volatility. He didn't beat the market over the last 20-30 years. Also, his portfolio is pretty much back-tested, not reality. So focus on the value, see how it goes. Also think about diversification over time. If now emerging markets are cheap, you might have 50, 60, 70% exposure to emerging markets. And then in 5 years, if those are exuberantly priced, then you might lower it down. But don't fix yourself on portfolio exposure now, because I would not buy something else just to have the academic sense of portfolio exposure, diversification, and buy something that is of lower quality and sell something of better quality just because somebody says you have to have 20% here, 20% here, 20 here, 20 here. That's irrational, which leads to portfolio concentration versus diversification discussion. I made a video in the past about that. You might want to check more into that. But for me, it's always about quality. If I could find free businesses that are amazing, I would hold just free businesses. As Charlie Munger says, Costco, Berkshire, and Li Lu's fund in China. And that's about it. So also Nick Sleep, Amazon, Costco, I don't remember the other stocks now by heart. But think of it from a value perspective, and that's also what I do with my intrinsic value table. I'm trying to find value no matter what. I'm trying to find the best risk and reward no matter where, and when I find it, I really don't care about exposure. I care about the individual risks of these companies, not about the portfolio exposure, because that's nice to chat about, but not really adding value to what I do. So if you enjoyed this video, a few more to make, please smash that like button, and I'll see you in the next video.